Well, hello again. This is Amy Wall. I'm really, really thrilled. We're going to dive right in today, and I want to introduce you. So I'm going to put all the people calling in to ask questions on hold, and then when we're ready to take questions, you'll press *7, and that'll open up your line to ask. We also have the webcast going, so if you're listening via the internet, welcome, and there is a chat mode that we have going as well, so you can definitely type your questions into the chat box. I will make sure we're there. Great. We've got Juan Carlos on the chat line. I see we've got Jack from Colorado, I think is where Survivor Jack is. And, oh, yep, Aurora, Colorado. Let's see. Oh, and more people are popping in. This morning is really, really special, and I'm really thrilled. As most of you know, with these calls, I really look at this like it's a community, and it's about moving inventors and creativity forward in business. And I'm really selective about who I invite to come talk to people, and it has to be somebody that I feel can really add value to your projects and value to you as people and business people. And I'm really excited to have met Tom when we were both coaching entrepreneurs for an investor competition that's coming up September 16th. And we were evaluating pitches together, and we were talking with these entrepreneurs. And what struck me most about Tom is, while he's very credentialed and very well respected in the investment community and in the venture capital world, he's really cool, for one thing, and he's got a lot of passion, and he wants businesses, this is my impression, that Tom's desire is to have businesses really embody everything they're meant to be, and he cares a lot. And there was this immediate connection from my part over that for Tom. And he had really perceptive comments and really well thought out, well informed feedback for people. So I highly recommend his new book, which is How to Create the Next Facebook. And Tom's going to do something really special with us. So right now you want to write down my company's Facebook page if you've got a pen handy, because you're going to want to know that in a little bit here. So our Facebook page is facebook.com/products, PRODUCTS, 2, which is TO, profits, PROFITS. And seriously, you're going to want to know that in just a little bit. So with that, I want to make sure to give everybody the logistics of the call. We're going to have Tom do about 10 minutes of content on startup company finances, which is such a great topic, and there's so much to say in it. And then we're going to move into a live Q&A. If you're new to the call, and I see we have a bunch of new people, this call could qualify as public disclosure of an invention. So if you haven't filed for a patent and you think you're going to, be judicious about the details that you share, or you could void your rights to patent. I'm not an attorney. I'm a product development person, but we work with IP all the time. So I just want to make sure that we notify you of that. And with that, I want to invite Tom to open up his line. I think you should actually already be unmuted. Are you there, Tom?
Yep, I'm here.
Awesome. Well, everyone, this is Tom, and like I said, Tom's got a really big heart for entrepreneurs. He's been one. He's built and sold his own businesses, and so he's written for Entrepreneur, Forbes.com, all around finance, and he's really involved with the IPO world and the venture capital world in Los Angeles as well as San Francisco. So, Tom, welcome to the call today.
Well, thanks very much, Amy. That was a great introduction. Thanks very much. I'm glad to be here as well. Sounds like they're a really good program.
It's a really, really fun group of people, and I know that they're all ears for you. We've got probably about 25 people coming in live, and then we have the webcast as well. So,
okay,
welcome,
excellent.
everyone.
Thank you. Yeah, so, Amy and I met recently and, had a chance to look at different companies. And I always love looking at companies and hearing about new ideas and answering any questions that may come out of that. And like Amy said, my background is as an entrepreneur, but way back in the 90s. And but since then, I've written some books, written articles, all kinds of facets of startups. But a lot of it does kind of revolve around my background, which is finance and the tax side. But again, I talk to a lot of entrepreneurs because I write reports and so forth. So, I touch a lot on marketing or go-to-market or all types of different things, and talk to a lot of great people, very successful people on that end. So I thought, so for this 10 minutes, talk a little bit about, sounds like an issue for a lot of companies. It sounds like who might be on this call is trying to figure out this whole entity idea. Should I remain a sole proprietorship, or should I incorporate? And if I do incorporate, should it be a C corp? Should it be an S corp, LLC? And I'm from California, and which means a lot of taxes here. And and so if you are going to incorporate here in California or most states, you'll probably have to pay some type of not only filing fee but a franchise tax fee. And here in California, it's $800. So it is a big decision to make. And then I would say too is that the main purpose of incorporating, if you decide to do that, it really has to do with liability protection. So you are liable to the extent of what you invest your money in the company. But that is not foolproof. I thought, work with some companies. A friend of mine starting this boat company where, people freestyle on a boat. And I told them, your corporation will be great in some ways, but if someone, gets in an accident, it's not going to help you at all. With negligence, you need insurance for that. So even though you might feel like you're protected with a corporation, you may not be. Or you sign a personal guarantee to get a loan, which is very common. Well, your corporation is not going to help you if that loan goes to zero. You're still going to have to pay it or recognize income on that if the loan is written off. If you do not pay your payroll taxes, which I highly recommend that you absolutely do pay your payroll taxes, corporation IRS is not going to care whether you're a corporation or not. So when it comes to liability, it really has to do more with civil liability, dispute with the vendor, and so forth. So when it comes to incorporation, I would say that if you have no assets, actually a lot of entrepreneurs don't have a lot of assets. They don't have a home or stocks or bonds, stuff like that. And you get sued, you're probably not going to get sued because you have no assets. In that sense, the corporation doesn't really help you. But if you have a lot of assets and you're starting to do business with vendors and companies and customers and so forth, it's probably a good idea to think about that because it could provide some level of protection in that case.
Yeah, and you know what, Tom, just let me interject for a quick sec.
Yeah.
If you're doing business with a big retail store like a lot of our clients do and people on this call do, they're going to require it, and they're going to require product liability insurance.
Right.
So, that should all be done under an entity. So,
absolutely. Yeah, if you're going to do business with Walmart and you do not have a corporation, I think you're in trouble. One, they're probably not, like you said, not going to pay attention to you, and they're going to require it. But that's just one step. You got to do the insurance and make sure that there's something substantial behind the company. And I also think, so if you decide to do the corporation, there's the LLC and there's the S corp and then the C corp. Everyone provides you with the liability protection. And I don't think Walmart would care which one that you are. The difference would really come down to taxes and then the complexities and paperwork. So if you do a C corp, a lot of paperwork. You need annual reports, you have board meetings and so forth. Whereas LLC, very little paperwork. It could just be you as a shareholder, and and also the taxes are pretty easy to handle with an LLC or an S corp. And in fact, with an S corp, you do have to set yourself up as an employee, but any profits above that or dividends, are not subject to Social Security or payroll tax, and so that could be valuable, and that's why a lot of the smaller businesses or privately held businesses are S corps, because you can get that advantage. It's even bigger advantage because of the new Obamacare rules on Medicare too. So that's important.
Hey, Tom.
Yeah.
Could you talk a little bit about the difference when you're capital raising between like an LLC and a corporation? Because I know that's something that we get questioned on all the time, and I handle that, but I want to hear your perspective on it.
Yeah, that was the final thing I was going to talk about, and that's where exactly the next where I was going to go. So it's perfect timing.
Awesome.
When I started my business, I went with LLC because I read some stuff and some articles. So back even before I think there was the internet, so I think I read Entrepreneur Magazine. They said go with an LLC. I went with an LLC. Turned out to be a disaster getting venture capital. The fact is, if you want to go get venture capital, you need to be not only a C corp, but a Delaware C corp. That's it. Basically, that's what it's all about, and primarily because Delaware understands corporate law. They get things done fast. They know what to do, and VCs understand it, and they want C corps because for tax purposes on their end, not on your end. It's actually better for them for their tax purposes for a fund. So if you do think you're going to get institutional capital, or be private equity or venture capital, you need to go to C corp, a Delaware C corp. If it's going to be, maybe just, friends and family and maybe some angels, I think you can get away with LLC or S corp. Now, there is something also to consider too, is that, given that nowadays, to get employees and top-notch employees, you can a lot of times give out stock options. A lot easier if you have a separate C corp. It's almost, you can kind of do it with an LLC, but it costs a lot of money. Probably cheaper just to go to C corp. And if you want to issue stock options and those kinds of things. So yeah, if your game plan, includes raising capital and significant millions of dollars in capital, the S corp is really the way to go.
So what would you call significant capital?
I think over $1 million. Below that you're talking angels and friends and family.
Right.
Like that. A regular VC is not going to do anything less than $1 million. You see sometimes these angel funds or seed funds, they may do $500,000, but we're talking at least hundreds of thousands of dollars, to $1 million range. For thinking about whether you should go with C corp or LLC or S corp.
Got it. That's a great distinction because a lot of people don't understand the differences between the kinds of investors. What is an angel round? What is a VC? Like that kind of area. I want to make sure that we leave a bunch of time for questions, and so we've got about 15 minutes left. How about we open up the lines and take some live questions?
That'd be great.
If you got a question, you can press *7, and that'll actually, let's do this differently. Okay, cool. Press *2, and that'll let us know that you've got a question. I'll open up your line. So if you've got a question for Tom, press *2. Oh, and I see we've got one right away from a caller 8. Your number ends in 8119. So, yes, hi.
This is Karen McMurray.
Hi, Karen.
Hello. I have a question real quick. What is the typical return does a VC expect on an investment and or an angel? I've heard all kinds of things across the board, and I've talked to some of them, and some of them say 7 times the amount they give you, or is it a percentage, or, I just kind of want to get an understanding.
Yeah. Well, first of all, this goes to the entity question, too. They're not going to get common stock. They're going to get preferred stock. It's a different type of stock. It's a special stock. So if they get a return, they will probably get interest on top of that and get their money back and plus a percentage of the upside. So, could be an investor in that sense. So they do protect themselves in a lot of ways, as much as possible. And they also have a lot of power. They usually get on the board of directors and have a lot of influence on what direction the company goes. And in terms of what they're looking for is that a typical venture capital investment, could take 7 to 10 years to pay off, whether it be it may result in acquisition or it may go public at some point. In the case of Facebook, it took 10 years until the company went public. So, the early investors had to wait a long time, unless they, some will sell off earlier, but generally it takes, a long time. So, and early stage investments are highly risky. So the rule of thumb is that, maybe 1 or 2 of your investments will really do well, and the rest will either go to zero or go nowhere. So to really make a good return, the general rule is they want to see at least a 10x return. So if you're offering them something that doesn't really scale, really can't become a billion-dollar company or really can't be a huge company, most VCs would not be interested at that point. Angels are a lot different. Because, they may, there may be more of a personal relationship or they like to get involved with smaller companies. But the VCs, that's how they operate.
Okay. And the angels, what do they want as a return? Typically, same thing, 10 return?
Yeah, they all think they're VCs, so they'll say 10%.
Yeah.
So
okay.
They think they're better than VCs. So they'll want, they kind of act like VCs and try to get it. But what winds up happening is that, this is where it's important to pick your investors that are seasoned investors, because if you get money from someone who's not, they could call you up every week, test you about what's happening. You don't want to do that for 10 years.
Mm-hmm. Yeah. Thank you so much.
That's a great point. So, Karen, you can press, actually, let me just mute you from here. It'll be a little easier. Who's got our next question? Press *2, and that will raise your hand so that we can take care of you today. Who's got a question for Tom? And I do have the chat window up and the Q&A. So if you're on the webcast, you can type a question in the window that's on the page you're looking at. Should be, I think, over on the left. So let me check over there and go over and see if we've got any. Okay. So, Tom, this is a pretty deep topic. And so I just want to make sure that everybody's breathing, for one thing, because a lot of people, when they're new to being an entrepreneur, I want to just ask you a question real quick. What was it like for you the first time you pitched to investors for your business?
Well, when I started, it was in software, so it was my brain is what I used to create this, so I didn't really need any capital. But as time went by and we realized we needed some capital, so the first type of capital we got was from angel investors. And that was just primarily through people we knew. So we had a corporate attorney, we got contacts we got from our attorney, people that we knew who were interested in investing. And for them, it really wasn't any type of formal type of process. We just, met up at a coffee shop, talked about the idea, ongoing questions, and it's like it's like getting a lot of cats to do, stay in one spot and herding cats, which is not a fun thing to do. So, I think we raised maybe $100,000 first time for Angel, and then we with venture capital over time, I started developing some. So that process, was a little unnerving. I had no idea what I was doing, but I had an executive summary. I think I'm given at a PowerPoint. But I had also had a company that was also operating, so that probably helped out a little bit. And so it's hard to remember. I don't, you just go with what you have and stick to your guns and focus on all the positives, and they'll ask you about the negatives and try to deal with that. And then with venture capital, it was more formal. So you go into a conference room, you have your PowerPoint, but a lot of times you kind of know who you're dealing with anyway, 'cause you've talked to them before. And the presentation may be more of a formality. They kind of already know they want to go ahead.
Right.
Yeah.
We actually have a question that someone typed in from the webcast, and Juan Carlos wants to know about what would be the perfect business plan skeleton to present to an investor. That's a big topic.
Well, one, don't use a business plan. Don't get those business plan books. Don't get those business plan software products. Business plans just take too long to create. And investors, I would say venture capitalists, and I'd say a lot of angels don't even read them and don't expect them. What you really want to do is, put together a simple PowerPoint presentation, and then if you could have some appendix, like an appendix or an attachment. I usually use it as an Excel spreadsheet with the financials and the projections. But I would not write a formal business plan. You might have to do that for a loan. But for equity investors, for VCs, they don't expect they would think that you're spending too much time writing a business plan, not running a business and thinking about your business. So I would stick to the PowerPoint, not running the business plan.
That's typically what I recommend.
Yeah.
Is maybe a PowerPoint and an executive summary, like a one-page.
Yeah. Keep it simple.
That's kind of it.
Yeah, and talk about, you want to start off saying, this is what we do. And it's amazing, like when we met, we were looking at Ellen's presentation. So many of them, it's not even until you get halfway through the presentation that they even tell you what they do. So you just want to hit over their head what you do, and start off strong. Start off with what you've already done, that you're getting traction, that there is interest in what you have to do. Talk about how big the market is. And then the one area that I think is the biggest problem for most entrepreneurs that they really rarely cover well enough or cover at all is how they're going to get customers.
Right.
What's their go-to-market distribution strategy? So, you want to, you're trying to tell a story, you're trying to get investors interested and get them excited about your idea and about the opportunity. And a lot of times that doesn't mean, you go into some of your product, but not all your product, but you talk about how you're going to get these customers, how they're going to pay you, how you get paid, how you're going to get to 100 million, how you're going to get to $1 billion, things like that.
The other big gap, we saw this at the session where we met, actually, was big gap in how does the investor get their money back?
Yeah. Well, they usually don't. And I would say that I wouldn't spend too much time on that because a sophisticated investor knows the risks and knows the options. And, if it's a long-term, kind of a VC deal, they know it's going to be probably some type of acquisition or IPO.
Right.
But there's some companies that are, keep in mind, very few companies, go IPO. I think this year we may have 250 companies that go public here in the United States. There are millions of companies in the United States, and only 250 go public. Now there are thousands and thousands that are purchased every year, but that's, again, out of millions of companies. So when you're raising capital, you're really saying you're a special company. You're one of the rare companies that will either go public or be bought at a premium. So that's why it's important to show that this is a huge market opportunity. You have a tremendous team, you have tremendous product, the market's huge, and stuff like that. You got to really put on a show.